Welcome to the Stockouts. This is your show at FreightWaves for all things related to the consumer packaged goods, CPG industry. I am your host, Mike Baudendistel. I'm the head of intermodal solutions here at FreightWaves. And in addition to following the rail and intermodal industry, I also follow the CPG industry. And what I'm going to do with this show today, this is going to be the final one of 2022. I'm going to talk about 10 trends that I'm expecting in the CPG industry in 2023. And I get production to be 26 minutes to do this. So let's call it 2.5 minutes a trend. So I'll get right into it. The first trend here is CPG margins will begin to recover in 2023. The CPG industry has gone through 2 consecutive years where margins have really contracted, and that was because their costs had inflated faster than those prices could be passed on through the retail channel and on to consumers. I think that trend will start to reverse in 2023 after 2 consecutive years. Now, I did say that a year ago when I talked about my expectations for 2022, but none of us anticipated the Ukraine war and all the impacts that it would have. If you take a look at the CPI chart, compare that to the PPI, this is overall the consumer price index in white, the producer price index there in blue, and you've seen how that producer price index has sort of peaked. That's for all commodities, and I think there's a pattern that's at least directionally the same in the CPG industry, where CPG companies are starting to benefit, at least as far as their costs are concerned, from decline in commodity prices. It does take longer for that to work its way through the retail channel, if it is going to work its way through the retail channel at all. I think a lot of those price increases that have been pushed onto consumers will likely stay where they are, rather than come down, and maybe they're just make it so those places where prices will be able to stay flat for the next couple of years, rather than rising every year. I think that's something that consumers would like to see, but I'm not expecting those prices to fall down as much as the input costs come down. So I think the CPG industry, which in general, a lot of those companies had a few hundred basis points of margin pressure last year and had a couple hundred more this year, they'll start to see their margins improve next year. So that's good news for CPG companies. And that gets to my next trend. Second trend here is I'm expecting elasticities to rise. And so that I think makes sense given how much the CPG companies have increased their prices. I mean, a lot of the CPG companies that I follow, you think of companies like Smucker, General Mills, Kraft Heinz, et cetera, a lot of their retail prices are 15% higher right now than they were a year ago. And then if you look at back, another year further, a lot of those are up sort of mid to high single digits from the previous year. So you've had 2 consecutive years of prices on shelves for these consumer products outpacing overall levels of inflation. I think it stands to reason that elasticities will start to rise. So consumers will start to consume smaller quantities of a lot of those products. So far, elasticities have held up very well. I mean, a lot of the CPGs, even earlier this year, were talking about how they really hadn't seen any change in volume, even in response to those higher prices, consumers getting used to those higher prices in the last quarter or so. However, some of the CPGs have changed their tone a little bit, where they've started to say, well, elasticities are low based on our expectations or based on history, but they're starting to creep up, and they're sort of, quote, low but rising elasticities. And you can sort of look at what's happening in Europe as kind of a preview of coming attractions, maybe, where a lot of these CPG companies that have a significant European presence are saying that their volumes are dropping in Europe. The elasticities there are higher in Europe than they are in the U.S. That makes sense with energy prices actually higher, in Europe in response to the Ukraine war, and that seems to be having a bigger impact on European consumers. I think as the U.S. consumers get to be more stretched, we've talked a lot on this show about how the credit card balances are rising, savings rates are low, that consumers will start to pull back more. Hopefully the job market continues to be tight, but that's also a risk that that could loosen up and find its way into lower consumer spending. Although for CPG companies, that would be kind of a double-edged sword because they've had a lot of trouble, recruiting and retaining employees as well. So, potential for a looser job market. That's kind of a double-edged sword for CPGs. But overall, would expect elasticities to rise. A lot of the companies that have done it, increased prices 4 or 5% have seen maybe the volumes decline 1 or 2%, but those that are up in that sort of 15% range, like a lot of them are now, still relatively low elasticities, but we expect those to rise. That leads me to trend number 3. Grocers versus big box competition will intensify. So just think of those traditional grocery retailers. And really one of the big events that happened this year is this pending Kroger-Albertsons acquisition. I view that as a defensive move against the big box retailers like Walmart, Sam's Club, Costco, which have really taken a lot of share in groceries. And Kroger Albertsons trying to get that back. I think when with that acquisition, they have talked about going out to CPGs as being sort of one unified force, and the CPGs will have to respond to that. Maybe they face a little bit tougher competition versus some of the private label brands that both Kroger and Albertsons own. And if there's a silver lining there, it's maybe the CPG companies that sell into those traditional grocers can take advantage of the enhanced data that Kroger will have. Kroger's going to have data on something like 100 million consumers in the U.S. So, and those are households. So pretty much every household that shops at a traditional grocery chain, Kroger is going to have a lot of data on those households. CPGs could do things like having very targeted advertisements, promotions that are targeted to people who sort of have a habit of buying their competitors' products. So I think you're going to see more like that, but really just lots of competition between the big box retailers and the traditional grocers for consumers, various promotions to get them in the door. It'll be interesting to see if Walmart continues to gain share among grocery shoppers or if some of that goes back to Kroger. But it's pretty clear, I think Kroger is not going to go down without a fight. The next trend here I have for you is retailers will stop accepting CPG price increases. So I think the relations between the CPG companies and the retailers have gotten to be more contentious over the past couple of years. The CPG companies, typically do, go to the retailers and ask for price increases. I don't know, maybe once a year, maybe it's more frequent than that. But clearly, inflation in the CPG costs have been stronger and lasted longer than I think anyone would have expected. So a lot of those CPG companies have gone to retailers more frequently than the retailers would have liked and have asked for steeper price increases than the retailers would have liked. So those relations a little bit frayed, but I think now that commodity prices have come down for a lot of those key agriculture inputs, that a lot of the retailers are looking at what the CPG costs should be growing and are going to start to say no more as far as accepting further price increases. So the CPG companies that are relatively well positioned are those that have already gone to the retailer, asked for all the price increase that they're going to need to cover their cost increases, and basically don't have to ask for a lot more in 2023. And I'm looking at companies like Nestle called that out as maybe asking for price increases early rather than later. I believe Smucker said something similar in its analyst call. But I think their margins are going to be the ones where those companies are going to see the margins improve. Maybe the smaller CPGs that weren't that aggressive early, they're going to have margins that are still below targeted levels. The next trend here is CPGs will have to adjust to new food regulations. This was a year where there was a lot of discussion, a lot of new regulations that went into effect. And so from the CPG company's perspective, some of the things that they're going to have to deal with is this redefinition of healthy to take attention away from fat, put more attention on maybe sugar, maybe salt. So some CPG companies are going to have to adjust to that. There's also pressure from the Biden administration to make labels easier to read. There was a health and sort of welfare summit recently on food and food deserts and a lot of these food topics. But one of the things that they talked about was labels on foods that are easier to read. Have an example of a food label there. And so that label, just like that, would go on the right in the front of a package. It would take away space from the graphics or whatever the CPG company wants to put on there. And it tells a consumer right away, okay, look out, this is high in sugar. It's 38% of my daily sugar intake. And someone trying to watch their weight all of a sudden knows that they don't want to see that. That would bring the U.S. more in line with what some countries in Europe are doing. That's an example from the U.K. Health minister of what a good front of package label looks like. So I think it's all about making sure that consumers are informed about what they are putting into their bodies. I know that the CPG companies, at least through their industry associations, have come out against those type of things. That does take away from the packaging space to get their point across. It takes away from maybe some of the branding that they would rather have. I think there's maybe other regulations coming down the pipe. I mean, now the FDA has issued these final rules on food tracking, where there's going to be greater requirements for the various players in the food supply chain to track certain KPIs of when there are handoffs with food. Now, those don't fully go into effect for 3 years, but the CPG companies will probably need all of those 3 years to make sure that they have all of their sort of ducks in a row in order to make good with those orders. And then there's also, I think, the issue that there's too much concentration in certain parts of the food industry, and really that pertains mostly to the meat industry. Biden administration has issued a number of reports on talking about the concentration in the meat industry and why that's to blame for a lot of the rising food prices. Maybe some of those concerns have died down just a little bit because the meat inflation was not as bad this past year as it was last year. But still, there's still 4 major producers that produce 85 or 90% of the packaged meat, the meat processors. So that's still a concern that I think those companies are going to have to make the argument that it is a competitive marketplace. Topic number 6 to watch out for in 2023 is CPGs will continue to refine their product portfolios. That's something we've seen the last few years is CPGs have gravitated towards positioning their product portfolios for the types of foods that will still sell well when consumers are cutting back on their budget. So those are premium foods. Those are a lot of pet foods, a lot of sort of fresh foods, things like vitamins, things that are health related. Those all tend to hold up better. I would even put in, another inelastic food category would be things like coffee, soft drinks. CPG companies will continue to position their product portfolio in those ways. I did see that JANA Partners Activist Fund took a position in fresh pets. So, maybe it's not a sort of across the board thing that all pet food and fresh food will do well. There's sort of rising competition in pet food, but expect the CPGs to do more with their position their SKUs. I also think they're going to continue to cut a lot of the SKUs that do not sell as quickly or are lower margin. And the companies most able to do that are the ones that can cut an SKU, and then the consumers will gravitate towards another SKU in that product portfolio. You think of like the Smucker company with all its different types of coffee. It can cut a few of them, and those coffee drinkers will probably go to another packaged coffee that Smucker owns. Next trend here to watch is I think less capital will flow into alternative foods in 2023. And I think a big part of that is the collapse in Beyond Meat has pretty major implications. Have a stock chart, ugly looking stock chart there with CPG or with Beyond Meat. And some of those issues are company specific. But Beyond Meat's had a sort of a dreadful year. They did things like rolled out products that weren't ready. I think there was also been less interest from consumers in trying new types of products that are more expensive. a lot of those products didn't taste as good, and I think they rolled out too many, and I think they had a lot of the wrong corporate partners trying to position themselves with the fast food companies. But you also wonder, is it just going to be, sort of this company that investors are less interested in, or are they also going to be less interested in companies like Impossible Foods, which, you go back a couple of years and it looked like Impossible Foods would go public pretty soon. That's back when Beyond Meat was trading up at $200 a share and was 13 billion in market cap. Now it's less than $1 billion in market cap. So there's just a lot less interest from those owners. It appears that they want to go public. And then it sort of brings up the other question is, as far as other sort of food source alternatives go, is there going to be less interest there from venture capitalists? And I'm thinking about things like cell-based meat, where they grow certain meat in a lab, or vertical farming, which is indoor farming, where you can have that, anywhere, very close to consumption centers. There's actually a big indoor farming facility from a company we had on the show that has their facility in Compton, California. Not a place you think of as being a big agriculture, but if you can do that indoors, it can make sense potentially. But you do wonder if there's going to be less interest in those things, now. Moving on to trend number 8, CPGs will experience fewer supply chain issues. This is hopefully not just wishful thinking, but it's something that CPG companies have really struggled with lately, and some of the ones that have performed the best have been the ones that have kind of done less worse on their supply chain, if you will. General Mills has gained share from Kellogg's because they've had an easier time keeping General Mills products on shelves. But General Mills themselves said, well, they've really had greater challenges with supply chains than they typically have. Ingredients not showing up on time, not knowing when the truck with the ingredients is going to arrive, all of those things. Kraft Heinz said that on any given day, that company is lacking either some ingredient or some piece of packaging, that they just never have a day where they have everything they need to make all the packaged food products that they would like. So a lot of CPG market shares kind of reflect that. It was also a big reason why CPG companies, the national CPG companies, took share from a lot of private labels during the pandemic, is simply those products were on shelves, their supply chains held up better. I think in this coming year, there will be fewer of those challenges. Part of that is there will be a looser freight market. And also, I think a lot of these companies have sort of moved to multiple suppliers of ingredients, so they're not so beholden to one. I think some also are holding more in inventory, going instead of just from a just in time to a just in case. I think that makes a lot of sense with packaged food, although the rising interest rates does make holding any of those inventories more challenging. So it has been an interesting dichotomy when you listen to some of these retailers would say, well, we have way too much in inventory of certain general merchandise products, not enough food products. We're still trying to increase, how much of those we have. But I think in general, next year, fewer supply chain challenges. Move on to trend number 9 is I'm expecting freight contract rates to fall, and have a graphic on there showing van contract rates, if we can bring that up from Sonar. So these are dry van rates. In white, you see the van contract rates, and those peaked earlier this year at about $3 thereabouts, and comparing those to spot rates in this chart in orange, and those spot rates are adjusted to exclude fuel surcharges. Typically, spot rates include everything. They include the fuel, but we're making a calculation to exclude those using a base of $1.20 a mile, which is sort of the typical base for what fuel surcharges are based off of. And you see how those, at the left part of that chart, they're typically higher than the contract rates. And that is kind of the market reacting, rationally. But those really started to fall right around the beginning of this year, and they haven't really relented all that much, although there's a little bit of a seasonal increase just because this is kind of crunch time for getting, some products on shelves. But in general, what you're looking at there is an unsustainably wide gap where the spot rates are below contract rates by, let's call it 65 cents a mile. Those are likely to, that spread is likely to collapse and even reverse, where you'll again have the spot rates above contract rates. But I mean, really, it's going to be more the contract rates, it appears, coming down to where those spot rates are. And just about the most positive thing I've heard on the industry lately is there are some analysts who speculate that the spot rates are not going to get much lower from where they are. Maybe that's optimistic thinking now that we're heading into the sort of the weaker months of the year in January and February. But suffice it to say, view of FreightWaves is that van contract rates and really the contract freight rates in general have a long way to fall, particularly on the highway. Moving on to the next topic is going to be the final trend I'll talk about, and this is a topic I could talk about for a long time if I wanted to. Rail service will continue to improve under regulatory pressure, and just listened to a lot of the hearing last week where Union Pacific was testifying before the U.S. Surface Transportation Board. The U.S. Surface Transportation Board is the organization that oversees economic issues of the railroads, and what they were hearing was the Union Pacific's overuse from their perspective, and from the shipper's perspective, was overuse of embargoes. And so typically what you would have is only have railroad embargoes when there's a hurricane, polar vortex, flood, some unusual sort of act of God. But Union Pacific has been using those embargoes sort of as a matter of sort of regular course, and has issued over 1,000 year to date. You go back to 2017, it's only been 17 embargoes. So, sort of dramatic increase. Union Pacific was using them more than every other Class 1 railroad combined. And the shippers are howling about this. Labor says it's because that they have not hired enough people, that they cut into the bone when the volumes came back, and the railroads had not been able to hire back the employees because the morale issues are bad, and the morale issues are bad because they're too much time away from home, too few employees for how much work there is to be done, et cetera, et cetera. And it does seem like the U.S. Surface Transportation Board is very concerned about the use of those embargoes. It was a kind of an unusual step earlier this year when this U.S. Surface Transportation Board ordered Union Pacific to provide basically an emergency order to expedite and prioritize trains to move animal feed into foster farms, and they did that so that the animals would get the food they needed, sort of at the threat that those animals were going to have to be euthanized prematurely. So, unusual step for the Surface Transportation Board. It wouldn't surprise me if there is, other ideas and other regulations coming on from in regard to sort of minimum service levels that the Surface Transportation Board could provide. So a lot to be worked through there, and also a lot of service issues to be ironed out on rail intermodal as well. Have a chart from Burlington Northern Santa Fe, the other West Coast railroad, and so this is data that Surface Transportation Board is collecting, and this focuses strictly on intermodal. And sort of the good news here is, these are delay days in blue, sort of the total delay days, and then sort of broken those down by crewing availability in orange, locomotive power availability, and there's a lot of other, which is just kind of what the railroads are using as kind of other, congestion, which can be kind of a catch-all. And, I do think that service will improve for one reason. I think the volumes are going to be constrained in rail intermodal, and then for another, I think there's going to be a lot of regulatory pressure that the rails have to adhere to their common carrier obligation. Maybe less of an impact, or if maybe not an impact at all on the intermodal side of things. But I think those shippers that move on the rail carload side will likely see better service. You would hope that Union Pacific would not issue another 1,000 embargoes in 2023, but I think there's going to be a lot of regulatory pressure, at least in this current iteration of the U.S. Surface Transportation Board. I think it's starting to get away from its reputation as being kind of a paper tiger in terms of not being tough enough on the railroads. So those are 10 trends that I'm seeing in CPG in 2023. And if I've missed any, would encourage anyone to reach out to me. You can find me on LinkedIn. You can reach out to me directly at Baudendistel at FreightWaves.com. And the easiest way to maybe see that email address would be to sign up for the Stock Out newsletter, which try to get the one or two newsletters out every week. And the easiest way to do that, just go to FreightWaves.com, go up to newsletters, and right there under supply chains, you can see the Stock Out. So I talk about these type of issues, talk about what I'm seeing that's interesting in the consumer packaged goods industry or the freight industry or the supply chain as it relates to packaged food, other types of consumer packaged products, and really just will write about any sort of data topics that I find interesting in FreightWaves Sonar. And with that, that's really what I wanted to go over today, and hope everyone has a great holiday season.